Welcome to Metechi podcast. Today we're going to discuss the effects of the crisis on the financial industry. With us, our guest, Ron Shevlin. Good morning, Ron.
Good morning, Zohar. Thanks for having me.
Would you mind introducing yourself to our audience?
No, not at all. Ron Shevlin, I'm the Director of Research at a consulting firm called Cornerstone Advisors out of Scottsdale, Arizona, although I am based in the Northeast in Boston myself. I've been with Cornerstone for about 5 years. I lead their research efforts. We do a lot of commission research for the banking industry, and my background is basically in the technology analyst world. I spent close to 20 years in the analyst business with two firms in particular, IT Group and Forrester Research before that. I was in consulting, so I basically have been a consultant or advisor to management for the past 30 years or so.
And I add that Ron is also the author of the Amazon best-selling book, Smarter Bank, and is among the top fintech influencer globally. And we are so fortunate to have him with us. Thank you so much for joining us, Ron.
Thanks, Zohar.
So the coronavirus crisis poses challenges throughout the economy. And how do you see the fintech companies coping with the crisis?
It's hard to give you a blanket answer to that, Zohar, because some will do well coming out of this and some are not going to do very well coming out of this. If you look at the way fintech companies have evolved in the past 10 years, to kind of take a broad brush of this, they've kind of evolved in two paths, either direct to consumer or more of a B2B type of a play. For the next 12 to 18 months, those that have taken a direct-to-consumer path are probably going to find it a bit harder road to hoe in the short term. For those that have focused more on B2B, I think they're going to find their lots a little bit easier in life because the banks are coming out of this not well, not great, but still on fairly strong footing, and are feeling the push to invest more in digital capabilities. So that will help those fintechs that have been focusing more on a B2B type of a model. But in both lending in particular and the neobanks or the challenger banks, they are going to face a tough 12 to 18 months.
And that's because the consumers are in a bad shape?
The combination of consumers being in a worse shape than they have been in, but a lot of it has come back to their business model. If you look at the neobanks or the challenger banks, companies like Chime and Varo and so forth, they've gained some good ground in the past couple of years. But really, despite the numbers that they advertise about how many customers they have, they're not stealing customers away from the big banks. What people have been doing over the past couple of years, Zohar, especially in the banking space, is what they're doing is what I like to call accessorizing their bank accounts. How like you go out at night and you put your jewelry on and your rings and your bracelets, and maybe not you, but your wife maybe, you accessorize. And for consumers in the banking space, these neobank or challenger banks are really accessory accounts. People don't close out their main accounts. They open up additional accounts to get some sort of feature or capability they want, like better interest rates or better debit card rewards or better personal financial management tools. And so for many of those challenger banks, their business model has been focused a lot on generating revenue through interchange fees. That's from a long-term perspective. I never thought that was a great business model to begin with, because the downward the long-term trend for that's definitely downward. But with payment volume down, that's going to put even more pressure on those companies. On the lending side of the coin, I've been fond of saying over the past couple of years that there's absolutely nothing easier in the industry than lending money. Collecting money, that's the hard part. Anybody can lend money. And so what's happening is, the roosters are coming home to roost, or whatever that saying is. And as we go into a downturn into the economy, credit quality is going to decrease on the consumer side. It's going to make it more difficult for these fintech lenders to collect. I think some of them are going to be looking at, significantly higher loss ratios and so forth on their portfolios. And the demand for loans is going to shift towards a lower quality borrower. So this is going to put a lot of these fintech lenders, and you've already seen some of them struggle, Cabbage in particular on the small business side. Both retail and small business are going to struggle. So that's why I see the direct to consumer plays as having a tough time.
If I understand that correctly, you are not a big believer in this model, regardless of the crisis. So the crisis just accelerated your predictions.
To a certain extent, yes. On the B2C side, I think many of these, the mantra of many fintech startups, maybe not in the past year or two, but certainly in the past 2 to 5 years, has been, we're going to disrupt the banks. We're going, banks are dinosaurs. We're going to put them out of business. That's never come to pass. It's never going to come to pass. Yes, there will be some banks that will fail, of course, but they're not going to disappear en masse, like dinosaurs and become extinct. It's just not the way it's going. It's not the way it's going to go. And to some extent, it's a repeat of the dot-com era from 20 years ago, the late 90s, early 2000s, when there was a big run-up in the startup of firms who didn't have solid business models. And Zohar, I think the bottom line of this is that, we're seeing a repeat of that. We're seeing a lot of fintech startups who just simply don't have strong business models. If you're going to thrive in an industry, or thrive as an organization, you have to do one of two things. You either have to make money, you have to generate revenue, or you have to have a technology that's so valuable that somebody else wants to buy it to incorporate it into what they do. I thought for a while that might be the path with some of these neobank challenger banks. A couple of years ago, I wrote a blog post about how I thought Movin would end up, Brett King's neobank Movin. I predicted that they would be bought out by a bank and would become basically their, millennial acquisition arm. That never came to pass, and now Movin's out of the direct-to-consumer business and focusing strictly on B2B. For some of the others, it's tough. I will tell you this, I do hear some rumors that Chime is doing more, looking for more bank partnerships or ways to work with banks. And I think that's a reflection of two things. A smart strategy and approach, go where the money is. And B, realization that the direct-to-consumer model is going to be really difficult.
So Ron, let's move to the other arm of the financial industry. Let's move to the banks. How do you see the banks coping with this crisis?
To a large extent, I think in the short term, Zohar, there's no question that earnings have been hit. It will, maybe will continue for a couple more quarters. But in the long term scheme of things, that's no different than what's happened with other downturns in the economy. Not the only real difference, but one real difference here, of course, is that in past recessions and downturns, there's been more of a longer period of time to foresee this coming. We can start to see the downturn. It's been more gradual. This, of course, has been like pulling the rug out from under not just the banks, but the entire economy, with a hit that we've never seen in our lifetime. But I don't think that takes them, out of the game completely. Sure, there might be some failures. But what it's really doing, I think, from a longer term perspective, Zohar, is it's changing the mindsets of a lot of bank executives, who are forced to realize that physical distribution through branches and offices and, face-to-face communication. They overplayed that. They overinvested in branches. They overinvested in, enabling face-to-face communication, and not just face-to-face. What we're doing right now is face-to-face communication, and we are not in the same room, and it works pretty well, right? But this is the philosophical switch and shift that a lot of banks are going to be making coming out of this crisis, is the realization that they've over relied on physical branches when they really didn't need to, or relied on that physical presence that wasn't really necessary, because there is technology enabled, and this is a perfect example of it, that enables face-to-face communication without two of us being in the same room. Problem is, for many financial institutions and banks in particular, they've never made it convenient to do this. Do you, I think about my bank. There's a branch down the street. I don't ever kind of go there. I do get a letter every once in a while from somebody a couple towns over who claims to be my account manager, but I don't even know his name. It's probably changed since the last time I got a letter from him. But if I had a question and I had a list of people who I could call and do FaceTime with or Zoom with, that would be a great substitute for having to get up off my butt, drive down to a branch and talk to somebody because I have a question. And why do I have to do that? Because the banks have never enabled those questions to be answered or dealt with through the technology. This, I think, is the big shift. The rug is being pulled out from under them, and they are going to be making significantly more investments in really accelerating their digital transformation. And that's good news for a lot of fintech companies who have been taking more of a B2B approach, and looking to enable banks in their transformation versus trying to disrupt or displace them.
And how do you see them handling the challenges of their borrowers? I mean, giving a loan to a hotel or giving a loan to a building that has retail. How do you see the banks coping with the challenges that the borrowers are facing across the board? It takes from hospitality to retail to office, and even the prediction that multifamily is going to be hit hard. Some of the estimates talked about drop of about 6 to 7%.
Yeah. So again, a lot of banks, I think, from a commercial lending perspective, have found themselves too heavily weighted in commercial real estate. It's been the moneymaker for them for so long. And I think what happens is, and this is just human behavior, if we do something for 20, 30 years and it works for us, we're very reluctant to change that. And so if you're a banker making, money hand over fist for the past 20, 30 years doing commercial real estate, I don't care how many consultants come through the door and tell you that you're wrong in doing it. You're sitting there thinking, I'm making money doing this. I'm going to continue doing it up until the time where the rug gets pulled out from under you. And then the world changes. And so for many of them, this is going to be a bigger shock than just the next couple of quarters. But I have to say, there's a lot of stuff being written right now by people who are saying that this is going to change things forever. That this is it. This is this is the disruptive change in behavior. People won't be shopping in malls and in stores anymore. People won't be going out to restaurants anymore. And I'm just not so sure of that. I think we like what we were doing. We went to the store when we wanted to, and yes, e-commerce made it a lot convenient to do things, but we still went out to the stores to shop. We still went out to restaurants, and I think what happens with human nature, Zohar, is, look, it's going to take some time. It may take a year, before we go back to what we were doing. But I don't think that a lot of these behavioral changes are going to be 100%, completely changed. But for some period of time, this is going to really hurt the bank's, lending portfolios and force them to really rethink their strategies. And so I think what this is going to do is a couple of things. First of all, they're going to, from both a retail and commercial perspective, really be forced to do some loan modifications. Interestingly, I was asked the other day by a colleague if I had seen any fintechs who were helping with loan modifications. I didn't know. My colleagues didn't know of any either. So it suggests to me that there's a potential opportunity for some fintechs to kind of help with doing loan modifications. But other things that I think that banks are going to do to help deal with this crisis are more things like loan participations and other collaborative means of lending. And many have done that to date, but it has not been a very efficient approach. So I think many will be looking to change their strategies and looking to fintechs for help in both loan modification as well as participations and ways of facilitating a shift in strategy. Because for many of them, they may have their come to Jesus moment and realize we've been too heavily focused on real estate and want to change. But then the next question becomes, how do we do it? And if you're a bank looking at it, and this is what has been some of the hurdles for years, is you may see the writing on the wall that the world is changing, but if it's going to take you 3 to 5 years to build the capabilities and make that kind of shift, then you're out of the game. But this is where I think the fintech bank partnership and collaboration is going to work, is I think the fintechs are going to come in and help banks make those, accelerate that digital transformation, which is, fancy consultant talk for changing the strategies, faster than they would have been able to, left to their own devices. So I think we're looking at a world where, it's funny, I'm toying around with a blog post. You mentioned that, I write a lot. My blog is now on Forbes called Fintech Snark Tank. And an upcoming post, I'm toying with the title that COVID-19 is causing the death of what I'm calling fintech fetishism. And what I mean by fintech fetishism is, I'm using the word fetish not in any kind of kinky context, but it reflects or means, an over adoring, feeling towards something. And, I think when you look at what's been written about fintech, and it's been a little too fetishist. There are people who say things like, fintech companies have better ethics, a higher ethos than banks do. And yet, you start to see the trouble that Lending Club had, or, SoFi's executive. They're humans. They're no more ethical or less than the bankers are. But what this crisis has done has, I think, woken people up that, fintech's not going to disrupt banks. It's not any better or higher ethical or has a higher ethos than the banks. And I think we're going to see a much more collaborative environment between fintechs and banks going forward.
So that brings me to you already touched on that. Now that on one hand you have zero interest rates, on the other hand, the technology requirements are going to increase, and they are fixed costs. Regulatory requirements are going to be also a fixed cost for the banks. We do see many of the mid-sized banks trying to merge in order to achieve economies of scale. Do you think that the merging, that's the strategy of the future for these banks to achieve economies of scale?
Yes and no. Yes, in that trend is going to continue, but it has its limitations in terms of how much scale you can get. I mean, reality is if you're $1 billion community bank, feeling the pressure that you got to get bigger. How much bigger do you have to get? Well, some people will put out the number 10 billion. Well, what are you going to do? Merge, acquire 10 different $1 billion banks to get to the 10 billion? That will take you forever and be incredibly painful. Do you want to then just sell out to the mega bank or the large regional? At that point, what does $1 billion bank added into a $2 trillion mega bank offer? Nothing. Even a $150 billion super regional bank adding a $1 billion bank does nothing. So we're going to continue to see that trend because the bankers and credit union executives are feeling the pressure of having to get bigger, but there's only so much scale that's actually going to enable. The thing that I keep telling my clients, who are very predominantly mid-sized financial institutions, not necessarily community banks, but the community up to the regional level, is that you've got to rethink the idea of geography. You can only get so big by having a narrow geographic focus. And for many banks, and a good example of this sort of strategy is Incredible Bank up in Wisconsin that was doing a lot of RV loans and realized, there's only so much demand for RVs in Wisconsin, but there's plenty of demand for RVs in the rest of the country. How do we take this capability? How do we take this competency that we have and expand, past our geographic boundaries? And so, I like to call it playing bigger than you are. It's maybe a sports term, of appearing to be bigger than you are. And I think technology is the enabler to doing that. And that's what I'm telling a lot of my clients that they really need to start thinking about, is not just merging to achieve scale, but how do you leverage technology to play bigger than you are and expand beyond the geographic boundaries. Now, clearly, there are some charter limitations that banks are going to have in terms of, expanding, but, that's going to get chipped away over time. I think the regulators are beginning to realize that even things like CRA regulations are very outdated and based on, how do you force a digital bank to comply with CRA regulations when they may be headquartered in a particular location but do practically no business in that location. So similarly, I think the regulatory limitations on charters from a geographic perspective will continue to be chipped away, and we're going to start to see not necessarily bigger banks, but banks even at the existing size that they are, being able to achieve a better level of scale because they're overcoming the geographic boundaries that they have today. Only way they're going to be able to do that so far is through technology. You can't simply build a branch all over the country. It's just not, feasible. You don't even want to open offices and put people there. You need to achieve that scale through technology. And from a regulatory and compliance perspective, it's getting more complicated as well, and that's why I think technologies like artificial intelligence and machine learning are going to be the enablers of that capability. So it's not just about geographic scope. It's about realizing that as you scale up, things become a lot more complex in your business, and the only way you're going to be able to deal with that higher level of complexity is not by throwing more people at it, but by throwing more technology at it.
So, and when you speak about technology, I want to get the core of it. The technology, when I think about that, is about helping you leverage, helping the bank leverage each other balance sheet and each other underwriting abilities. Because the banks, 1 billion bank, 2 billion banks, whatever, they are spread over, so they have underwriting abilities in their local places. And the balance sheet of the many hundreds of and even thousands together of these banks is really huge. And it's just a matter of how to leverage each other abilities to underwrite a loan and use the balance sheet of other banks to create the economies of scale. And it can work both ways from the perspective of the banks. And that will be to the point of trying to get that without the merger, which is a very extreme type of transaction to achieve the economies of scale.
I think that's spot on, and that's exactly the way it's going to have to work, because there's only so many mergers you can do in a year. You just don't have the luxury of time to do that. And my argument would be too is, even if it were two $10 billion banks merging, you're still not achieving the levels of the economies of scale as a intermediary like a Metechi can offer in terms of bringing banks together, and you don't have to get into the contractual arrangements. Another thing, I've been talking with a lot of banks over the past couple of years, who are jumping on the fintech bandwagon and want to jump on this fintech partnership bandwagon. They want to partner with fintechs. And it makes for a great story because the boards have all been hammering them. What are we doing about fintech? What are you doing about fintech? And it provides a good story for them to say, yes, well, we're doing some partnerships with them. But just like two banks merging only achieves a certain economy of scale, partnering with one or two fintechs may not move the needle on your business very much. Unless it's hugely strategic, but that's probably not the case in a lot of these examples. And so, what you need is more of what the banks need is more of a platform type company helping them. So, if you look at not even in banking, let's just look at the retail space. You're a small merchant, a relatively small merchant selling whatever product you sell. You're sitting behind a picture, let's say it's, you're selling frames for artwork. You've got a little store there in, your suburban town in, New York, and you can only reach so many people. How do you grow? Well, you're not going to create a franchise. That's pretty difficult to do. But here's an Amazon. And Amazon has billions of customers, and they also have billions or hundreds of thousands of merchants selling. And as a result, you get a lot of people who go there to buy things. And you find that even though you got to pay Amazon a hefty fee to sell your wares, it's a hell of a lot more economical than any other approach. And you're able to achieve that because of that platform. Now, banks aren't necessarily, they've become a bit enthralled with the idea of becoming a platform. But more importantly, they need to look at other companies who are creating platforms as distribution channels. And so it's not just selling stuff. A platform is simply a company that acts as a magnet and brings both buyers and sellers, or providers of services and users of services. And if there's the network effect, if you get enough providers and users of those services, then it builds more and more people coming in. And if your technology, it's not just a matter of, so if you just did that, you wouldn't necessarily be a platform, you might just be a marketplace. To be a platform, you've got to really provide the integration capabilities. And so, it's not just about selling things, but you talk about underwriting. If there's a need to, pool resources, because we're looking at loans that exceed our capital levels or our risk levels, or we need to, mitigate something in that area, or we see an opportunity but don't have the capabilities to get into it, and we want to partner with other banks. Well, partnering thing is going to take forever to do. What many banks do today in the participation, they either rely on a broker who has personal relationships, or they rely on their own personal relationships. But when you get an Amazon, and what is an Amazon? An Amazon is that trusted intermediary. You don't vet as a seller on Amazon all the potential buyers. Amazon takes care of that for you. I mean, they enable the transaction. The buyers trust the platform, the sellers trust the platform. And in the banking world, the platforms that are going to emerge are really going to be the trust providers. They're the ones who say, we've vetted these other banks. You can trust us. We've vetted that they are solid, that they've got, you know, what they represent from an underwriting capability is true, that, you know, and you take away the work that's required on the other bank's perspective to have to do the vetting because you've done that, and you enable them to not have to get into one-to-one contractual relationships. So that platform model is, you know, beginning to grow within financial services, not just as a channel for distributing retail products, but as a mechanism for enabling this bank-to-bank collaboration as well as bank-to-fintech collaboration, and becomes a new way of doing business, not just selling. So this partnership model is really going to take off in the next 10 years.
I just read that you wrote about Google and the other giants also fitting within this model.
So, you know, a lot of the talk has been, oh, you know, Google and Amazon, oh, they're going to become a bank. They're going to put banks out of business. And I have not been very supportive of that approach or mindset at all. I think that they could make a lot more money by becoming vendors to banks than competitors to banks. You know, let's go back to Amazon. You know, Amazon, so a couple of years ago, the news was that Amazon had done $1 billion in merchant cash advances to its merchants. And that was proof, according to some people, that Amazon was going to get into lending and, of course, disrupt and displace a lot of banks. But, you know, Zohar, I don't think people were asking the right question. The right question was, why was it only $1 billion? Was that because that was all Amazon had to lend or advance? And I don't think that's the case. Is it because merchants only wanted $1 billion in merchant cash advances? I don't think that's it either. I think the answer is they were simply testing the waters to see, you know, if these were the best risks and how this would work. I think it's a lot more likely that the demand for merchant cash advances among sellers on Amazon's platform is probably in the $10 to $20 billion range. Now, what's Amazon going to do? Just take its little cut of the pie, you know, it's $1 billion and let the other 19 go fallow? No way. They're going to go out to the banks and go, hey, you guys want to do some merchant cash advances? You know, we can match you with these players. So Amazon's always going to compete for it to some extent, but they're going to get, you know, they're going to become, you know, distribution channel. Now, on the retail side, similar thing. You know, if you're a bank, you're trying to expand your geographic focus. You know, how are you going to do it? You got to go to the platforms. You go to a platform like Amazon. Amazon's going to be more than happy to take a small cut of that checking account that they help you open. But why would they stop there? They'll just simply say, hey, you know what? Not only will we help you find that customer, we'll help you onboard them. We'll do the account opening. We'll do the KYC because we've got capabilities of doing digital identity verification. You know, we'll do all of that and we'll charge you a fee. Now, once they start getting into that business, what stops them from saying, hey, listen, we'll just do your payment processing for you as well, and start getting deeper and deeper into the technology stack of the business. If you look at what Google's doing, similar thing. A story came out last November claiming that Google was going to launch a checking account called Cash, C-A-C-H-E, not C-A-S-H. What it really turns out is that what it really is a front end to a checking account. It's a tool that they're going to partner with banks on, not displace banks. And then recently they announced that they were offering an AI-based tool to help banks facilitate the Paycheck Protection Program loans. So more and more, what they're really doing is becoming more of a vendor to banks than a competitor, because they can make money on both sides of the equation, but you know, there's huge levels of, you know, dissatisfaction that banks have with their core vendors today. And I'm not saying that an Amazon or a Google are going to be any better a vendor, but you know, certainly there are opportunities, and banks are looking for different ways of doing things because the cores have been a little bit slow to adopt some things. So, you know, I think that there's a bigger opportunity for the big tech companies to be providers of technology services to the banks than competing with them.
Ron, this is a fascinating conversation, and it's amazing to listen to your insightful analysis about the financial market. We're really feeling extremely fortunate that you joined the Metechi podcast. If you want to leave us with some final words, I would be happy to hear that.
My final words are, I think I'm very optimistic that we are overcoming the crisis that we've been experiencing over the past couple of months. I'm no economist, even though I took economics in college, but that was a long time ago. But I'm not going to make a prediction about the recovery, but I'm very optimistic that we're going to recover a lot faster than a lot of people are predicting.
All right, we hope that this prediction will materialize. Everyone would support you on that. Thank you so much. It was a great pleasure. Thanks a lot.
Thanks, Zohar.